Revenue from contract with customers and the following exemption may be used to apply Section 115 retrospectively. For complete contract, you need a realized restate the contract that begins at the end of the same annual quoting period. The completed contract has a variable consideration option to use the transaction price at the date of contracts were completed rather than estimating the variable consideration amounts in the comparative reporting period for all the reporting period presented before. The entity should not need not disclose the amount of transaction allocation, remaining performance obligation and explanation. Now, when the entity expands recognition, then month as revenue. Joint agreement transaction and proportional consultation of joint extreme equity method to measure the initial investment at transaction date of the aggregate of carrying amount of assets and liability that the entity had previously proportionately consolidated, including goodwill arising on acquisition. A test to invest of impairment, regardless of whether there is an indication of such impairment. Any result impairment shall be recognized as adjustment to return the earning at the whole at the end of the transaction to the NDAs. To aggregate all the previous recognized assets and liability result in negative assets and have the legal constructive obligation that recognize corresponding liability. Other ways such as retaining earning, the transition of our equity method and accounting for assets and liability. Recognize the previous investment, recognize the shares of assets and liability in the respect of interest and joint operation. The difference between the amounts of net assets as per the NDA is previously recognized. If carrying amount of previous investment is lower, the offset against the goodwill relating to the investment, therefore retained earning. If the carrying amount of previous investment is higher, the adjusted retained earning. Transition provision of the centers for financial services. The recognition of investment and recognize assets and liability as per the transition from equity method to the account of assets and liability. Provide consolation between the amount in recognition reconciliation as adjustment to retain. The presentation of disclosure comparative information. The comparative information INDAs does not require historic summaries to comply with recognition, measurement, and requirement of NDAs. If any financial statement contains historic summaries and comparative information according to the previous gap, as entity shall label the previous gap information prominent not being prepared in accordance with NDAs. Disclose the nature of mean adjustment that would make it compiled with an AS. An entity need not qualify the adjustment. Explanation to transition of NDAs reconciliation. The equity has in gap, previous gap and NDAs will transition last year. The last year total comprehensive income is a gap and NDAs. Sufficient detail to understand adjustment to each lineup. Reconciliation to discuss corrective errors identified during transition of EA or the changes of accounting policy. The fair value of deemed cost and amount of adjustment. India statistics disclosure of impairment during transition. If adopted, the first time exemption option to disclose the fact of accounting policy until the time of plant, property, equipment, intangible assets, investment properties, or intangible assets significant depreciation impaired or de-recognized. The intra-financial report include consolidation with the entity and profit and loss under the previous cap. Further information to comply with the NDA 34. Illustration 16. Hatch Limited has the following assets and liability in the March of the financial year, prepared according to the previous cap. Plant property equipment 1 crore 44 lakhs, investment 48 lakhs, trade receivable 2 lakhs, advance and purchase of investment 50 lakhs, inventory 8 lakhs, cash 49,000. VAT deferred loan 16 lakhs, creditors 30 lakhs, short term borrowing 8 lakhs, provision 12 lakhs, share capital 1 crore 13 lakhs, 6,000 to 2 lakh 99,000, cumulative transaction balance 1 lakh, ESOP 20,000, and 2020 only 1 lakh 79,000, and total equity liability. The following gap difference were identified by the companies of first time evaluation of NDAs and effect on the 1st April 2000. The relation of plant property equipment, the following adjustment are not identified. Plant property equipment comprised of land as a capital appreciation purposes of 4,90,000 classified as investment, and property as per NDAs 14 exchange difference of 1 lakh was capitalized in depreciation property. Plant equipment on the accumulated depreciation of 40,000 was recognized. There was no asset retained obligations, and the management intends to adopt the deemed cost exemption to using the previous gap carrying value of deemed cost at the date of transaction of PPE and investment property. The company has made investment of estimated 40 lakh to 8 lakhs and carrying the fair value of 68 lakhs at transaction date. The company intended to recognize the investment of the fair value of the transaction. Final instruction. instruments. The VAT default loan 60 lakhs. The VAT default loan 60 lakhs is obligation authority for setting up the business and backward region with the condition to create certain defined targets for employment of local population in that region. Loan does not carry on any interest and is repayable to full at the end of 5 years. According to the NDAs, the discount factor of the loan is 10%, having an incremental borrowing rate. However, the fair value of the loan that was 27 lakhs 25,528 and the entity closing the expertise option of giving paragraph B11 of the NDAs 101 that is a choose entity chose to apply the requirement of NDAs 109 financial instrument and the NDAs 20 accounting for grant and disclosure of government assistance. Retrospectively, as required this information and been obligated to timely to initiate accounting of VAT deferred loan. The restore retained earning of companies contained ASOP reserves in 2000. The company has granted 1,000 option to employees out of 800 as already vested. Company follow the intrinsic value method to recognize the ESOP charge and consider 12,000 towards vesting options of 8,000 over the period of time. ESOP charge and corresponding reserve. The fair value method has been followed in accordance with the NDAS to honor to and corresponding charge over has been 15,000 and 9,000 has been vested and unvested shares respectively. Company intend to avail NDAs 101 exception of share-based payment for non-trusting the ESOP share as per the previous cap vested option. Cumulative transaction difference company as a non-internal foreign branch according to the AS 102 AS level as the recognized balance of 1 lakh as part of services. On the first allocation of the AS account, company intend to avail YS 101 exemption to resetting the accumulated different translation between zero, preparing transaction data in the AS and balance sheet of company, HUD showing adjustment as value of assets and liability. Solution adjustment of opening balance as per the India's 101. Land property equipment as a land has been capital appreciation purpose qualifies the investment property. As investment property shall be reclassified from the property, plant and equipment and investment property presented separately as a company adopt a previous gap man carrying out the deemed cost and all types of PPE in investment property should be carried on the previous gap carrying value. As a case, past capitalization exchange difference and there is no adjustment in this case. Investment in subsidiary is one type of adoption in India. It's a parent company has option to carry out investment in subsidiary at a fair value at the date of transaction in the separate financial statement. As such, the company can recognize such investment in the value of 6 to 8 lakhs financial instrument as a VAT deferred loan as financial liability under section 98 109. Liability would be recognized as the present value of discount and the property discount factor. Consequently, VAT deferred loan should be recognized at 37 lakh 20,528 and remaining 22 lakhs would be recognized as deferred loan, different government grant. ESOP India ES 101 provides exemption of not restating the accounting as per the previous gap in accordance with the India ES 102 of all the options and as vested by the transaction date according to the 1,000 ESOP granted. The first time adaptation exemption is available to 800 option that has been already vested. As such as the accounting need not be restated. However, 200 option has not vested and the transaction date need to be restated in accordance with the India ES 105. As the additional impact of 1,000 that is 9,000 less is 8,000 which is according in opening NDA's balance sheet. Cumulative transaction after difference. As per the paragraph D12 of NDA's 101, the first time adaptation is available on exemption regarding requirement of NDA's 21 contact of cumulative transaction difference. It is the first time adopter uses exemption. The cumulative transaction differences all the foreign operations are deemed to be zero as a transaction did in this case a balance of transfer to retained earning as thus the balance 1 lakh should be transferred to retained earning. Later on increase in fair value of investment 20 lakhs additionally ESOP of unsaved 30,000 further cumulative transaction difference between returned earning 1 lakhs so 20 lakhs 99,000 transaction of NDA's balance sheet after the above adjustment is carrying value ability transaction data of NDA's balance sheet of H limited first different non-current asset plant property equipment 1 lakh 35,000 gap adjustment 4 lakh 50,000 so NDA's gap 1 lakh 30,000 property zero so or added 4 lakh 50,000. Yeah, current asset inventory 8 lakhs fixed asset investment in years about 8 lakhs minus one adding 20 lakhs or 68 lakhs trade receivable 2 lakhs cash 49,000 other current asset advance on the purpose of investment 50 lakhs total asset purchase of in share capital 1 lakh 30,000 30,000 other equity cumulative transaction difference 1 lakh reduce 1 lakh at constant so returned earning and ESOP 20,000 plus 1,000 so 21,000 returned earning 1 lakh 79,000 plus 20 lakhs plus 1 lakh minus 1000 plus 1 lakh 29,000 is 22 lakhs 79,000. Other current asset VAT deferred liability 22 lakh 60 lakhs minus 22 lakhs 79,000 37 lakh 20,524. Government grant 22 76 74 462. Trade pay defer current liability financial liability trade payable 30 lakhs short term provision 8 lakhs provision 12 lakhs total liability total liquid liability 24 42 99 and added 20 lakh 22 2 crore 62 99,000. Shaurya Limited is a company having registered in corporate office in New Delhi. 60% of Shaurya Limited shares held by the government of India and rest of its investors. It is the first time Shaurya Limited is applying India for the preparation of financials for the current financial year for the balance sheet report as per the gap. Shareholder fund capital resources surplus 25 lakhs on current liability 50,000 long term provision 350,000 deferred tax liability 350,000 current liability 22 lakhs current liability 4,000 short term provisions and non current assets from plant property equity lakhs tangible asset 20 lakhs 2 lakhs goodwill 1 lakh non current investment 5 lakhs long term goods and process 5,000 non current asset 2 lakhs current asset current investment 18 lakhs inventory 20,000 current receivable 9 lakhs cash and cash equivalent 10 lakhs other current is 34 lakhs total 85 lakhs additional information of because 1,000 other current liability include 3 lakh 90,000 liability to be paid in cash of each expenses payable salary payable 60,000 salary and government use the long term loans advance of 40,000 remains amount consistent advance of 100 other current assets of 3 lakh 2 lakhs again capital reserves of place other current assets include 3,00,000 current assets receivable cash and prepaid expense 1,000 short term provision including dividend pay 2 lakhs and dividend payable on result of board meeting or in the declaration of dividend in the financial account negative amount however subject to the approval of shareholders in the central annual central meeting. The Chief Financial Officer Shaurya Limited has also presented the following information against the corresponding relevant items and balance sheet. Plant, property, plant equipment consists class of assets and office buildings whose carrying amount is 10 lakh. Other fair value of said buildings on the data of first 15 lakhs. Company wants to follow the revaluation method. Although, for the respect of the plant, property, equipment, the fair value of intangible assets as on the date of transaction of estimated to be 2,50,000. However, management returned to incorporate fair value, change the books of the Shaurya as an acquire 80% of the shares of company Excel Private Limited made a few years further by acquire the control of company. Shaurya Limited recognized a goodwill as per the estimate accounting standard by the accounting the excess of a consideration paid over the net asset acquired and the date of acquisition for the fair value exercise are not done at the time of acquisition. Trade receivable includes the amount of 20,000 as a provision of doubtful debt measured in accordance with the previous gap as on the latest estimates using the hindsight provision need to be revised. The company had given a loan of 1 lakh in equity at the terms of 10 years of 6 years, 6 all transaction costs of incurred separate the loan. This loan carried out the rate of 7% the principal amount to be paid and equal installment over the period of 10 years. And the interest payable on every Indian land that fair value of the loan on the data of transaction 50,000 and gains the amount of loan present amount 40,000. However, the IND is 109 mandate the recognition of interest income as per the efficient interest method after the adjustment transaction cost management says that the integers has to give and apply the effect and interest rate and the retrospective effect of the hence going to apply of the same retrospective first event. The long-term borrowing for liability is a component of the due towards state government interest payable the government on 4%. However, the prevailing rate of the market rate is 8%. The market fair of channels 2017. After the provision of the gap, the multi-mutual funds are measured the cost of market price, whichever is lower, and TA's company is assigned to the investment and the fair value of the profit and loss. Value of mutual funds in previous gap is 2 lakhs, including current investment. However, the fair value of mutual funds is dated 2 lakhs. Ignore the separate calculation deferred tax above adjustment. It is assumed the deferred tax of income 30,000 amount of interest transaction adjustment requirement. Prepare transaction rate of the period of balance sheet of Shaurya Limited as India and codified. Now necessary explanation as to the each of this time. Presently, Chief Financial Officer from debts and rate of transaction date and DS balance sheet. Particular non-current asset and plant and property gap 20 lakhs transaction 5 lakhs increment 25 lakhs and Non-current asset, asset, current asset, goodwill 1 lakh, 1 lakh, other tangible asset 2 lakh, 2 lakh, financial asset, investment 5 lakhs, loans 40,000, my interest 10,000, 40,000, other current asset 1 lakh 10,000, another current asset 2 lakhs, 2 lakhs, another current asset, inventory 12 lakh 50,000, financial asset, investment 18 lakhs 30,000, 8 lakh 30,000, trade receivable 99 lakhs, 9 lakh, 9 lakh, cash 12 lakhs, 1 lakhs, other financial asset and total asset, equity share capital 10 lakhs, and other equity 25 lakhs, 7 lakh 50,000. 90,000 respectively, and borrowing liability for hotline of 90,000, provision 3 lakh 50,000, default tax liability minus 3 lakhs, current liability, financial liability, trade payable 2 lakhs, other financial liability 39 lakhs, and 38 lakh 20,000, other current liability 60,000, provision 12 lakhs minus 2 lakhs 10 lakhs. Other equity, as per the financial retained earning 290,000, present value, fair value 5 lakhs. So both we add 32 lakhs. Working on capital, retained earning balance of the early achieved 25 lakhs. Transaction adjustment of loan of fair 10,000 added. Transaction adjustment of increase in mutual value 30,000. Transaction adjustment due to decrease in default tax liability 50,000, so increase. Transaction adjustment decrease in provision dividend 2 lakhs. So 29 lakh, 27 lakhs 90,000. Disclosure forming a part of the financial statement. A proposed dividend on the equity shares is subject to the approval of shareholder, company at the annual general meeting, and should not recognize as liability as on the balance sheet date. Plant property equipment, as per the DeFi Indies 101, the equity may select the measure of the item of plant and property equipment. The date of transaction of Indies at the fair value as use the fair value as a deemed cost at the date. Para T7A has an applied at all the items of plant property equipment. So DeFi exemptions take into business and DAs which will have to be applied retrospectively other assets as well, since the entity elect the measure of items of land property equipment at the date of transition. India is at the fair value, use the fair value as a deemed cost of debt, and it assumes that carrying value of the asset is based on the retrospective application. The equal value of file is 10 lakhs. Goodwill India is 103 mandate requires measure to assets and liability in the acquiry as a fair value in the date of acquisition. However, the first time adopter may elect to not to apply the provision of 103 and retrospective effect and a correspond occurred period of date of transition in days, since the company is not continuing to carry goodwill in the books of account as per the provision cap. Intangible assets. The path was D7 range or D6 or the NDA is 101 first time adopter in like the previous gap or revaluation and before the date of transition of NDA is deemed cost of the data revaluation. If the revaluation was the data of revaluation broadly compared to fair cost of replacement cost according to NDAs and just to reflect the, for example, changes in general and specific price index. However, when the requirement is in addition, intangible asset must be made the definition of recognition criteria of NDA 38. Hence, the company may avail of the exemption in the NDAs 101 as a rate of transaction use of carrying value as gap. Loan para P8C of NDAs 101 says that impracticable represent to NDAs 8 as an entity to apply retrospectively effect of interest method and as 109 as a fair value of financial asset or the financial liability and the date of transaction in NDAs shall be the few new gross carrying amount of financial asset and new amortized cost of financial liability and the date of transaction according to 50,000 was a gross amount carrying amount the loan difference of 10,000 shall be adjusted to the regarding a mutual loss accounts para of the and in not one state and the entities permitted to designate previous recognized financial asset and the financial assets measured on the fair value through profit and loss in accordance with the para D19A. Entity shall disclose the fair value of financial asset to discriminate the entity date of designation and the classification and the carrying amount of previous financial year. D19A states that the entity may designate the financial asset as measure of fair value through the profit and loss accordance. NDAs 109 and the basis of the fact of settlements that exist on the date of transition of to NDAs, the trade receivable. Para 9014 of the NDAs 101 stated that the entity estimates accordance with NDAs at the date of transition. NDA shall be consistent with the estimate made to the same date in accordance with previous gap after adjustment to reflect the difference in accounting policies, unless there is an objective evidence that those estimates were error. Para 16 of NDAS 101 further states that entity may receive information after the date of transaction NDAs after estimate it has made under the previous gap in accordance with the paragraph 14. An entity shall treat the receipt of information the same way as a non-adjustable event and after reporting period in accordance with the NDA's and events after reporting period. The entity shall not reflect the information in opening NDA's balance sheet unless estimate needs adjustment for an difference in the accounting policy or the objective evidence of the estimated error. Instead of the entity shall reflect the new information in the profit and loss account appropriate to comprehensive income in the year of 31st 2019. Government grant India para 10A of NDA's 20 state the benefit of the government loan to the below market rate of interest treated as a government grant. The loan shall be recognized as a measure in accordance with the India's financial investment. The benefit of the market below rate of interest shall be assured of the difference between the initial carrying value of the loan determined in accordance with the one India's 109 and the preceding received benefit accounted in accordance with according to the standard. However, B10 of India's 101 state that the first time adopter shall classify all the government loan received as financial liability and equity instrument in accordance with the NDA's 32 financial instrument presentation except the permitted paragraph 11. First time adopter shall apply the requirement of India's 109 financial instrument and India's 20 according to government grant and sources of government assistance. Perspective of the government loan exists in the date of transaction and India and shall not recognize the corresponding benefit of government loan below market rate of interest and government grant. Consequently, the first date of adopter it does not understand the previous gap recognizes a measure of government loan market below market rate of interest on the cross basis consistent indicates and shall be previous gap and carrying amount of the loans at the date of the transaction and NDA is carrying amount of loans opening of NDA's balance sheet. An entity shall apply the IAS 109 measuring of the loans of the date of transaction of NDAs. The dividend should be deducted on the retained earning during the year when it has been deducted after according to the deviation and declare of the previous percentage shall be reversed. To rectify the wrong error, retained earning should be increased proportionate due to the adjustment. Carve out of India is not one from IFRS. The definition of gap under India is not one. As per the IFRS, I have defined in the previous gap as per the basis of accounting that first time Maratha uses immediate before the adoption of IFRS calendar. The NDAS 101 defines the previous gap as a basis of accounting that first time Maratha uses the reporting requirement of Indian immediately before the adoption of NDAs. The change made it mandatory for the Indian entities to consider the financial statement report in accordance with the notified accounting standard as applicable to the previous gap when transition to NDAs. Reason. The change make it mandatory for an Indian company to consider the financial statement prepared in accordance with the accounting standard notified under the companies. The accounting standard rules 2006 for a previous gap when a transition to NDAs as the law prevailing Indian recognized only the financial statement prepared in accordance with the Companies Act 2013, allowing use carrying cost plant and making property plant equipment on the date of transition of NDAs as per the IFRS first time adoption international accounting standard provide that the date of transition eighth time plant item property plant equipment shall be determined applying IND's property IAS property that plant property kept respectively of the same shall be recorded in the fair value and previous gap evaluation revaluation and subject to certain requirement. Carving out the paragraph D say 7A of IND is provided additional option to carrying the value of all the items of property plant and equipment the rate of transaction accordance with the previous gap and acceptable date starting point of NDAs. In the case of old companies retrospective application of NDAs, the fair value of the date of transaction is determined the deemed cost as may be possible in the old asset. According to the NDAs, provide the relief to the entity to carrying the value of the items of plant and property. Equipment the date of transaction in accordance with the previous gap was acceptable starting point of NDAs. Long-term foreign currency monetary items as per the IFRS, no provision of IFRS problem. The paragraph D13A appendix D of NDAS 1 provide that first time adopter may continue to policy adopted for the accounting for exchange difference arising in translation. Long-term foreign currency monetary item and recognized on the financial statement of the period ending immediately before the beginning of the first NDAS reporting as per the previous gap. Consequently, NDAS 21 also provide that it does not comply with the long-term foreign currency monetary item for which entity has adopted the exemption given in the D13 14A. Appendix D of NDA 701. Such entity may continue to apply accounting policy to operate such current long-term foreign currency monetary items. Reason paragraph 46A of NDA's 11 provides the option to recognize long-term foreign currency monetary item as a part of the cost of property, plant and equipment before the recognition or statement of profit and loss over the period of loan causes the loans not related to acquisition of assets. To provide transition relief, such entities have given an option to continue and default of exchange difference as the case may be the foreign currency borrowing obtained before the beginning of the first NDA's reporting period. Intangible asset arising from served concession arrangement relating to toll road accounted for according to appendix 10 of service concession arrangement 2 NDAs 1 for revenue from contract to customer as per IFRS. No provision IFRS 1 covered NDAs. IND one of the permits the first time adopted to continue the policy adopted the amortization intangible assets arising from a service concession and arrangement relating to toll roads and recognition of financial assets in the period ending immediate before the beginning of first NDAs and the period of the previous year. As a consequence of the above, paragraph A has been inserted in the NDA's 38 scope of the entity to apply amortized method to adopt for amortizing intangible asset arising from the service concession arrangement with respect to the toll road recognized in the financial statement for the period ending and including before the beginning of the first NDA's reporting period as per the exemption given in the para D22 of an appendix D of NDA's 101. Reason Schedule 2 of Company Setup Study allows the companies to use a revenue-based compensation intangible assets arising from the service concession arrangement relating to the toll roads and NDA 30 intangible asset allows the revenue-based amortization only in the circumstances when the predominant limiting factors that is inherent the limitation asset is achieved in the revenue threshold. In order to provide relief to the intangibles, NDA 38 and NDA 101 has been amended to allow the entities to continue to use accounting policy adopted by the amortization of intangible asset arising from the service concession arrangement relating to the toll road recognition in the financial asset for the period ending immediately before the beginning of the first NDA's financial year. In other words, NDA 38 would become applicable to the amortization of intangible asset arising from service concession arrangement relating to toll roads entered into after the implementation of NDAs. A land building elements of lease contract as per the IFRS. No provision under the IFRS 1 covered. The paragraph D9AA provides that the entity which as a leaser can be used. A transition date affects the circumstances of lease arrangement which includes both the land and building element to cease the classification of the element of the finance and operation leads to the transition date of transition date to NDAs. Also, if there is any land lease nearly classified as a business lease, then the first time adopter may recognize assets and liability to fair value of this date and difference between the fair value recognized and retained earning. Reason this aspect of quite common in the Indian government Indian environment is that felt that first time adopters may face hardship as they were retrospectively assets to element of contract. Under Indian Accounting Standard of Agriculture study the objective of scope of standard defines the terms agricultural activity, agriculture products, bearer plants, biological asset, biological transform, explain the principle recognition, measurement, computing gains and loss, initial subsequent elements, and account for the grant and the biological asset, list out the various disclosure, describe the grant. Unit agriculture objective scope definition recognition measurement agriculture related activities general gain and losses inability of measure to fair value reliability disclosure general additional disclosure government funds. Introduction objective INDAS agriculture is the first standard that does specify the covers accounting and reporting of requirement of primary objective. Prior to the standard, there is no established guidance on the agricultural industry. Standard introduces a fair value method of agriculture and which is major shift from the traditional cost of modeling while applied to primary industry. INDAS whatever agriculture sets the objective of agricultural activity. Management of the transition, biological asset, living and plants, agriculture, produce, harvested, and the product of entities, biological asset, the entity standard generally requires biological asset to be measured the fair value less than cost. In case what you address the following key features when there should be biological asset, agriculture, produce, recognize balance sheet, and what would recognize a biological asset, agriculture, products, measurement. What would be difference in the value of recognized biological asset and agriculture products conduct to the two different reporting dates? What should be the key disclosure scope? Standard must apply the following related agriculture activity. Biological asset agriculture produce and the point of farmers are common game. In case whatever does not apply to land relating to agriculture activity. For example, land which biological asset grows in and regeneration, plant property and equipment and AS investment property. These are plants record agricultural activities. These are plants covered within the India 16 plant property equipment is accounted as per the scope of services. However, standard applies to produce this beer plant. The government grants related to the beer plant India is accounting of government grants and disclosure accounting of government assistance, intangible asset and associated with agricultural activity. For example, the license of right to cover days, 30 intangible assets and provision of the standard applicable. Right to use asset arising from the lease of lateral to intangible assets. The standard is applied to agriculture product, the harvester product and the entity of biological asset only at the point of harvest. Therefore, India's 2 is already applicable. Example 1. The proceeding grapes into the wine of winter goes grown grapes. While such processing may be logical and natural extension of agricultural activity, the event takes place when bearer of the simultaneous biological activity. Such processes now included within the definition of agricultural activities and standards. Agriculture product after the point of harvest is called bulls, meat, fruits, rubber, logs, and the process subsequently is not covered in the preview of the standard as per the indications applicable. As well, the below provides just examples of the biological asset agriculture produces that products that result of process after harvest. Sheep, wool, yarn, carpet, timber, agriculture products such as trees, fallen trees, log timber, dairy, milk, cheese, pigs, carcass, sausages, and cured palms. Cotton plants harvested thread, cloth, sugarcane harvest sugar, tobacco oil, pig leaf, cured tobacco, tea, butchers, tea leaves, tea, wine, tea, grapes, wine, grape, fruit trees, picked fruits, processed fruit, rubber trees, harvested latex and rubber products. Some of them is example of the some other example of tea, bush, grain, wines, and oil plants and rubber trees usually meet the definition of beer plants and within the scope of India 16 plant property equipment. However, the product grows into beer plant. Example of the tea leaves, grapes, plant fuels, latex within the scope of India's relevant definition. According to the key agriculture activities refer to the management of the entities and biological transformation, harvest, biological asset, or the sale of the conversion of agriculture product into additional biological asset. The standard state agriculture activity covered in the wide and range of activities rising like horse forestry, animal, parental crops, cultivating ostriches, plantation, florist, and aquaculture. Nevertheless, these agriculture activities has been certain common features, capabilities of change and living animals and plants and capable biological information. Management changes. Management facility biological transformation by enhancing at least a stabilizing condition necessary for processing to take place. For the example, nutrition level, moisture, temperature, fertility, and light. Such management distinguish agricultural activity with activities. For example, harvesting from managing sources such as ocean, fishes, and deforestation, non agricultural measurement of measurement management of change challenges quality, for example genetic merit, density, ripening, fat or cover, protein content, fiber, strength and quality, for example the progeny, weight and cubic meter fiber, like diameter and total number of birds. Through the biological transformation, harvest is measured and monitored in the routine manager function. India's part one does not deal with the process of agriculture product harvest. A standard makes it clear that even the processing is considered as a logical and natural extension of agricultural activity, as the event takes place in the some beer similar biological transformation. Some performance not included the deformation of agricultural activity. For example, the process of curing beer. It is a yeast fungus convert sugar into alcohol would not meet the definition of agricultural activity. In the standard, similar cheese production would falls across the definition of agricultural activity. Biological activity refer to the living animals and plants. Biological transformation in comparison are the comparisons of process of growth, degeneration, production, and procreation would be quality and quantitative methods of biological activities. Biological transformation, the process of causing the quantitative changes in the biological asset. Growth, degradation, production, procreation, growth, the increasing quantity and improving the quality of animals and plants. decreasing quantity or degradation of quality in the animal supplement production of animal product or agriculture products such as latex, tea leaf, oils, and milk procreation, creating an additional living animal or plant. Agriculture produces the harvest product of entity and biological asset. In India is 41 only applies to agriculture product is harvest product with the point of harvest, not point of subsequent to harvest. India is 41 unharvested agriculture plant production is considered as a part of biological asset from which it is harvested. Therefore, the harvest agriculture product should not be accounted for separately from the biological asset and which is come. For example, milk is accumulated as a part of the dairy cow right now to movement which is cow is milk subsequently harvest. The agriculture product in the accounted under the NDAS 2 and another standard applicable under the NDAS 2 agriculture product is initially recognized as an inventory as a far value of less cost and sale measuring according to the NDAS 41 which will become cost of NDAS purpose. Harvest the detachment produces with biological assets or the section of biological assets life process of fair value. The value which will be received to sell assets and paid towards the liability. Orderly transaction between market participant measurement and date. Definition of fair value in the India is 117 fair value measurement. Cost to sell the incremental cost directly attributable to disposal of asset, excluding finance costs and income taxes. Therefore, all the costs are necessary for the sales to occur and cost to sell include these would otherwise not as for example cost to sell these broker dealers commission leave to regulated agencies and a commodity exchange transfer tax duties beer plan may be defined in the plant living plan that it is a production supply of agriculture product expected to be a plants more than one period it is remotely likely to be sold in agriculture product except the incredible scrap sales. As the above criteria need to be met in the plan to consider a beer plant. Definition of the capture plant that would be initiated to consider the beer, for instance, of grape vines. Some plants may appear to be consumer, some are root systems and perennial plants like sugarcane, bamboos, asparagus. And this due to the perennial nature of this root system, they are recorded to meet the definition of beer plant. Annual crops and plants that are sold to harvest in agriculture. For example, there's traditional arable crops like maize, wheat, soya are the three crops from lumber. These exceptionally include conditioned beer urban additional plants that have dual use. Plant cultivate for beer or agriculture products for which they are more than remote like plant instead like harvest and so agriculture product beyond incidental scale. Example, entity holds rubber trees and sell both latex and agriculture product in the trees and lumber. For example, tea bushes, grape vines, oil palms, rubber trees usually meet the definition of beer plants and outside the scope of India is 41 hours and 2016. However, the produce, growing and beer plants biological concept. It is important to note that the animals on tree are not covered under the definition of beer plant. Example, sheep, cows are not a beer plant. And IBC Limited grows wines, harvest for grapes and participant uses activities of the same of was whatever. The grape wines are beer and continuously generate crops of grapes which is covered by the plant public when the entity harvests grapes, the biological transform case when became agriculture produce and cover interest in this agriculture. The wine includes lengthy matured period. This the process is similar to the conversion of raw material to finished goods rather than biological transformation. Hence, it has investment under section inventories. Recognition of asset like entities required to be recognized biological asset and agriculture produce when and only the following conditions are met. The entity controls assets as a result of past events. The control over biological assets and agricultural products may be evident by legal ownership and the right to control, for example, legal ownership of cattle and branding of otherwise making the cattle acquired both and bearing. It is durable that the future economic benefits associated with the assets will flow to the entity and future economic benefits expected to flow in enterprises for the ownership or control of assets. The further benefits are normally assessed by measuring the significant physical attribute. The fair value cost of asset can be measured reliably. Measurement biological asset would be measured the initial recognition and on end of the period and fair value of costless well lesson except to case where the fair value cannot be measured reliably. That is an presumption of fair value can be measured reliably in the biological asset. In the following cases, biological asset should be measured at the cost less than accumulated depreciation and accumulated impairment loss, and according to NDAs 2, NDA 16, NDA 36, quote at the market price is not available for the biological asset. Alternative fair value measure and determined as clear and reliable. On the fair value of the biological asset became reliable, measurable. Entity shall measure the fair value cost less minus sell, less cost to sell. The presumption to be reverted only in the initial recognition entity that previously measured the biological asset at the fair value less cost and sell. They continue to measure the biological asset at the fair value less cost to sell until disposal. In the cases entity measured agriculture produced the event of harvest at the fair value less cost. Standard reflects the value that fair value of agriculture produces at the point of harvest, and always in matured reliably. Agricultural products. The harvest from the entity's biological asset should be measured at the very least cost. Agricultural products harvested from the entity biological asset should be measured at the fair value cost less to sale at the point of harvest as measuring the cost at the date when the applying indicates to apply is other applicable under fair value measure of biological asset. Agriculture product can be estimated by grouping biological asset and agriculture product attributed to significant attribute. For example, each of quantity the entity select the attribute corresponding attribute used to the market basis by the fair value less cost to sell the biological asset can change due to the both physical character and price change in the market. Entity often entered into contract to sell the biological asset agriculture product at the future date. The contract price are not necessarily relevant to measure fair value because the fair value reflects current market condition in which market participant buyers and sellers would enter into a trading. As a result of fair value of biological asset, an agriculture produce is not adjusted between the existing contract cost plus cost may substantially approximate the fair value of the a later biological transformation has been taking place since the initial cost increase. For example, the fruit tree seeding plant immediately prior to the end of reporting period and newly acquired crops. Impact of biological transformation is a price is not expected on the material. For example, initial growth of areas and plantation production cycle. Biological asset is often a physical attractive plant. For example, trees is a plantation forest. This may be not separate market for biological asset that is attached to the land, but activity market may exist in the combined asset. It is a biological asset and raw land and land improved or package. Entity may be used information regarding the combination asset to measure the fair value of biological asset. For example, fair value of a land, raw land and land improvement may be deducted from the fair value of combined asset to arrive at the fair value of biological asset. Biological asset recognition measurement. The entity control assets are the result of past events. It is a probable future economic benefit associated with assets of flow of entity. Fair value of cost of the asset may be measured label. Measurement initial recognition the end of the each reporting period. The fair value less cost to sell expectation. The presumption can be reverted only in the initial recognition of the biological asset when the quoted market is not available. Alternative fair value measure alternative clearly and reliable in the case of the measurement of cost less accumulated depreciation and the accumulated impairment loss. Once the fair value of biological asset became reliable measure, the entity shall measured the fair value less cost to sell. Once the non-current biological asset meets a criteria to classify the date of sale that is included in the disposal group of financial classified the date of sale. India is not 5% of the fair value measure. Illustrated the farmer owns dairy 3 years of old cap. Fair value is 13,550. Number of cattle is 250. And and the three value 3 cattle is 31st March 60 per cattle. The fair value of the 4 cattle is 100. Calculate the measure of a group of physical changes. A fair value of variable 13,000 increase due to increase in price 250 minus 1 to 60 minus 13 250 is 1 to 5 increase in physical place 250 to 75 otherwise fair values at the end of reporting period biological assets 5,000 increases being changed in category one is a group of reporting As we said, then purchase 100 cheap from the market of 5 lakhs. Transaction cost to a person. Transaction 2% of the marketplace of sheep is incurred, which is paid in the seller, and the sleep fair value increase 5 lakh or 6 lakhs. Transaction cost is 2%, which is incurred on the seller to sell sheep. Determine journal entry, which is fair value of the cost to sell is 4 lakh 90,000. That's 5 lakhs minus 10,000. Expenses 10,000 is profit. Biological for 20,000 loss to initial recommendation to bank 5 lakhs. So biological asset purchased as on 35 March, the sheep would be measured in 5 lakh 88,000, and biological 6 lakhs minus 12,000 gain as 98,000, and 4 lakh 98,000 minus 5 lakh as recognized in this case. Biological asset to gain is 98,000. Gain change in fair value, being a change in value of recognition of end of financial period. Gain and loss biological asset. The gain or loss arising in initial recognition of biological asset are fair value cost to sale and sale from the change in fair value less cost to sell the biological asset shall be included in profit and loss of the period which will arise. The loss may arise in initial consideration of biological asset because the cost to sell the deduct and determine the fair value less cost to sell the biological asset. The gain may arise in the initial recognition of biological asset such when the cost is born during the reporting period of 21-22 entity cow which is given birth to cow. The fair value of estimated cost of sale is 5,000. The amount of 5,000 which is immediately recognized from the statement of profit and loss account. Agriculture products. The gain or loss arising in initial recognition of agriculture product, the fair value cost less to sell shall be incurred profit and loss of the period of the arise. Gain and loss may arise in the initial recognition of agriculture product, the result of harvest. Gain for biological asset gain or loss in the initial recognition gain and loss may arising between the cost to sell the retracted determine the value of the cost to sell of the biological asset. The gain may arise in reproduction or generation of this cough is born change in the fair value less cost to sell the reproduced turn the period talk to period period in which arises from the agriculture product gain or loss initial recognition gain or loss may arise in the initial recognition agriculture product and result of harvesting. Common gain biological asset arising in the fair value of cost unconditional grant relating to the biological asset measured at the fair value less cost to sell the recognized profit or loss varies only when the government grant became receivable. Conditional grant is the government grant related to the biological asset and measured at the fair value less cost to sell. Conditional including the government grants receiving entities not to be engaged in the selling agriculture activity. The entity shall recognize the government grant as profit or loss when it only condition attached to the government grant or not. The term condition government grant vary. For example, grant may require entity to farm in particular location 5 years and require the entity to return the entire grant of the farms a period shorter than 5 years. In this case, grant does not recognize profit and loss until the 5 years has passed. However, the terms of the grant follows part and retained and according to the time lapse in entity. Recognize and the part of the profit and loss of the impasse. Should an example for unlimited cultivate huge lot of land, agriculture like government offered a grant of 10 crores under the condition the land is being cultivated 5 years. Land will be cultivated for the shortened period. Entity is required to return the granted grant. Therefore, the government grant is recognized in the income only for 5 years and cultivated the cultivation where the difference to returning obligation deferred to the not cultivated land in which period. Rotation of grant for the period till which the entity has cultivated the land. In the case of amount 10 crore, which is recognized as the income on a proper and proportionate period of 2 crores per annum. Biological asset measured as a cost. If the government grant related to biological asset measured on the cost less any cumulative appreciation and any cumulative impaired loss, that is inability to measure the fair value of reliable IND 20 applies. Biological asset, dog biological asset. Measuring fair value cost to less when the grant is conditional. Recognize the government grant profit and loss account when the condition attached to it. When the grant is unconditional, recognize the government grant profit and loss account when it became receivable. Measure at cost to recognize as per the Ind AS 20. Researching the act of food limited runs on a poultry farm business. It receives a government grant from the government setting up a new poultry unit in the upper area. The agro food uses the amount of government grant to buy in first batch of broiler birds and incubators. The broiler birds are measured on the fair value as cost of when the bird component mission is measured as per the cost as per India 16 as well the no condition attached to the release the government granted purchase of poultry but however regarding the installation of incubators and related to plant machinery items government grant contains consider plant and machinery should be minimum of period of 3 years. The useful life of incubator should be determined 3 years according to the management estimate the time period over the economy review 10%. Incubator mission shall be consumed. Advise the accounting requirement of prescribed days. 41 agriculture India's 20 accounting for the government can disclose the government assistance in respect of both the government grants. In days what is unconditional government grant addition to the biological asset measured at the fair value, costless to sell recognized profit or loss when and only when the government grants became receivable. According to the amount the government grant attributes to the broader birds and qualifying biological asset shall be recognized in profit and loss account when the grant became receivable. If the government grant is conditional, including the government grants required entity not wanted to engage in specific agricultural activity, in addition to recognizing government grant to profit or loss when and only when the condition attached to the government grants are met. This provision of India is 41 is not applicable as when informed that there is no condition attached to the release of government grant to the provider birds. In a given case, the government grant related to the provider birds are already has been received for the purpose of providing immediate financial security with no future related condition to be fulfilled. According to the grant relating to the provider birds to be recognized profit and loss account period in which received. If the government grant related to the biological asset measured in the cost less than accumulated depreciation and accumulated impairment loss, entity applies India's 20 accounting for common grant and disclosure of accounting common assistance. The incubator of business does not qualify the biological asset as the specified creation of India 16 which states the plants and machinery items used to develop and maintain biological assets covered under India 16. Therefore, the provision related to common grant in India 41 will not apply to incubator mission. Therefore, we have to apply directly the provision of India 20. India 20 contains two methods of presenting financial statement and grant as per the appropriate portion of grants relating to the assets or retaining acceptable alternative. One method recognizes grant deferred income that is recognition in profit and loss account systematic basis over the useful life of asset. Another method deduction of grant in calculating carrying amount of asset. The grant is calculated in the profit and loss over the life of the depreciation asset as a reduced depreciation expenses. Therefore, the grant related to the incubator mission will be accounted for the deferred income that are recognized profit and loss systematic over 3 years. The line which condition attached to the grant. An alternative grant can be deducted and determine the carrying amount of the incubator. The key is the grant is recognized profit and loss over the 3 years. Help and useful life of the depreciation incubator mission is reduced depreciation exposure. Disclosure. Description of biological asset activity. The entity is required to it is required to provide a description of each groups of biological asset. This disclosure may turn forms a narrative qualifying description. It is recognized to provide qualifying description for each groups of biological asset and distinguish between the consumable, bearable biological asset between mature and immature biological asset as a property. Gain and loss of recognized during the period. Entity shall discuss the aggregated gain and loss arising during the current period and initial recognition biological asset. Agriculture produces forms of carrying the fair value of sold biological asset. Recognition changes biological asset. The default retained recognition solution the carrying amount of biological asset between beginning and end of the current period, which is another gain or loss arising and changing fair value less cost of sale increasing arising purchasing decreasing attribute to sale biological asset classified held sale including a bar disposal group. This is classified held discount and the accordance with the NDAS 105. decrease in value due to harvest, increase in result of business combination, net exchange difference arising in the transaction of financial statement into the different presentation currency, also transaction of foreign operation into the presentation currency and reporting entity and other charges, restriction asset and commitment to risk management strategies, entity show disclose existing and carrying amount of biological asset which titles restriction and carrying amount of biological asset in place to security and liabilities. Amount of commitments, development, acquiring a biological asset, and financial risk management strategy risk to agriculture activity. Additional disclosure when the fair value cannot be measured reasonably. If the biological asset in the scope of NDA is what even measured and the cost less and accumulated depreciation, other community impairment loss in the end of the period, the following disclosure to be included. Description of biological asset explanation and why fair value cannot be measured reliably. Ranging estimate within the fair value highly likely to be and depreciation method useful life of depreciation grass carrying amount of accumulated depreciation, impairment losses, and methods of introduce common grants. The following disclosure required in the common grants and relation to the common agricultural activity, the national extent of the common grant recognized. Fulfilling condition and other conditions attached in the common grant, significant decrease in expected to and have common grants. The Moon Limited reports and financial statement 31st March and 1st April 2017. The company carrying out the following transaction: purchase land 15 lakhs, purchase 200 dairies at the age of 1 April 2 years for 10 lakhs, and receiving grant of 1 million towards acquisition of cows. The grant 10 lakhs, 1 million 10 and the grant was not refundable. As per the 31st March, the company's incurred following costs: 6 lakhs maintain conditional animals for production, 4 lakhs of breeding the fee of the local farmer. On October, the 300 cows were born. There was no other changes in the number of animals during the period, and the 31st March has the 300 less. Now that is returned sold by inventory. Number is sold shortly after the year and end of the market prices. The fair value less cost to sell April, October, March. The land 50 lakhs, land 60 lakhs, and Mazda 20 lakhs. Newborn cows 1,000. Newborn cows per half 1,200. And half 6 months old calves 1,100, 1,200, 1,300. New year old calves 5,000, 5,100, 200. 3 year old calves 5,200, 5,300, 5,500. Milk per liter 20 rupees and 22 to 24. Prepare the extract of balance sheet and 31st March, reflecting the financial statement. Income purchase of coin, changes in value of purchase of common grant, change in the fair value of a newly born cow, fair value of milk, expenses, maintenance cost, and breeding cost of income. Extract of the balance sheet. Land product, land and biological asset, dairy cow, and calves and milk. Working notes and the purchase of land was not covered in DA 41, the relevant standard which is applied in the transaction of NDA 16. Under the standard, the land would initially record the cost and depreciation of the useful financial and useful economic life. This would usually be considered as infinite. The case the land is so or the depreciation would be appreciated under the cost model. No recognition would be made in the post acquisition. Post-acquisition changes the value of land, allowing alternative treatment of revaluation model to pretend the land to be revalued, the market value to revaluation purpose. Surplus taken into the comprehensive other comprehensive income would be followed the cost model. Dairy cows on the fair value model like to ADS 41. The mature cow would be recognized in the balance sheet 31st March in the fair value 200,000, 2,500. 40,000 increase in physical change 200 into 300. So 1 lakh. So total difference between the farmer and mature in the initial cost 11 lakhs minus 10 lakhs and gain is 1 lakh. This is recognized in the profit and loss account in the maintenance charges of trading 6 lakhs and 4 lakhs. Grand is agriculture activity is not subject to normal realization the government of the DS10 and DS91. The grant is completed the income as for the unconditioned receivable rather than recognized over the useful economic life of the grant. This 10 lakhs should be credited to the income of the company. related to income of the company, costs, biological asset, and the fair value, equipment, trading fees, charge to 100,000, 300 reckoning balance sheet, relative product initial recognize of the balance on the base on the biological asset. Number could be valued 2000 to 24 70,000 as recognize the cost and the future applicable to NDAs to unsold. Extract of financial statement of listed entities. The following are the extract of the financial statement of the listed entities. Avati V Limited financial year 21 biological asset. Part plan, public equity, capital work in progress, tangible asset, right to use of asset, right of use of asset, financial asset investment, loans, financial asset loans, financial other financial assets, non-current tax asset net, non-current asset, total non-current asset and current asset inventories, biological asset. Biological asset, note and broad stock and post level. The constellation changes carrying out the biological asset, particularly at the beginning of the year, due increase due to the purchase and production of physical damage, decrease in the physical damages, net change in the fair value of cost. Accounting policy. The accounting company recognizes a biological asset only when the company controls asset and result of the past event. It is probable that the future economic benefit associated with this asset is below of company. Biological asset companies are the nature of consumer biological asset is bifurcated into broad stock of parents and harvest spices undergoes biological transformation under the different stage of neolysis, Joda, mystics and post larvae. The company sells the biological asset harvested from the broad stock like Neopolis and post larvae stages. The broad stocks are maximum useful of 6 months of laying eggs and therefore in the standard and thereafter we are destroyed. Valuation of the broad stock biological asset determined the following is broad stock cost and captive contribution of supporting farmers cannot be sold before the end of the useful life and such. There is no active market. This reference to market prices, which is market prices and similar assets are also not available due to the uniqueness of valuation based on discount non-cash flow methods is considered as an unreliable based on the uncertainty which is a result of mortality rates and reproduction. Consequent of broad stock and stem seeds different stages and measured in less cost, less depreciation and less impairment losses. Transformation phase of the Neopolis to Zoya or Myces is not considered a significant transformation of biological asset. In Zoya and Myces are not valid as per India's whatever company recognizes biological asset the fair value of the cost of asset but are measurable, reliable expenditure incurred in the biological asset to measure the initial recognition at the end of the reporting period as a fair value, less cost as well. The gain as a loss arising from change in the fair value to see the biological asset included in the financial profit and loss are compared to the gains. Management estimates the fair value of cost in the biological asset, taking into the account of most reliable evidence available to each reporting period. The future realization of the biological asset may be affected by the survival rate in age or the other marketplace. The event changes that has reduced the future economic benefits associated with the asset. The fair values arrived in the base of observable marketplace and biological asset, adjusted the cost of sale and applicable. Indian accountant standard 103 business combination. Our studying to be able to explain the real business combination and examine the key difference between the and is 103 on account reporting. Identify the acquiring enterprises. Determine the acquisition date, purchase consideration under the various situation and contingency. Allocate purchase price, recognize assets and liability acquiring entities. Examine the measurement principles, calculate the bargain. Evaluate contingency, payments and employee shareholders and acquire share-based payments, award exchange of awards and acquire employee integration, subsequent measures and accounting principles or reaction rights and contingent liability and indemnifying assets and contingent consideration, appraising of disclosure required by the business combination, account distribution, non-cash map of assets to the owner to dividend and acquiring appendix A distributed non-cash assets to owner of mentioned voting period. Business control, the definition of elements of business combination of business. Acquisition, identify the acquired, determine the acquired date, purchase consideration, determine the purchase consideration, allocation of purchase consideration, recognition, identifying assets and acquired and liability as in goodwill gained from the bargain purchase, non-controlling interest of the acquirer. Subsequent measure of accounting, reacquiring rights, contingent liability, indemnified as rights, assets and contingent consideration, common control, transaction and disclosure. Reduction necessary to standard of business combination of India, showing the important consideration of fact that Indian companies are increasingly strengthening the business in foreign countries for the best fit of business competition. Presently in India, Indian accounts and accounting for amalgamations and lays and specific treatment of information. India's consolidated financial statement is applied in the consolidation. However, it does not match the global financial reporting after conversion of IFRS. India is 103, which is aligned with IFRS. It takes up with the global requirement of the business combination transaction which is acquired and obtained. Term business is defined as an integrated set of activities and assets that are capable of being conducted and managed in purpose of growing and purpose of providing goods and service to consumer and generating investment income such as dividend and income. Generating this income from ordinary activities, business combination is the most common form of business transaction through which companies grow size and rather funding activity. Business combination acquire difference from the way asset acquisition. This is the following are those difference in accounting and asset acquired in the business combination. Particular business combination acquire a business combination. Intangible assets are including goodwill. Intangible assets are recognized at fair value. It is separate identified. Goodwill is recognized as a separate asset. Intangible asset acquired in a part of group of asset would be recognized and measured based on the allocation of overall cost of transaction which refer to the relative value. No goodwill should be recognized as transaction cost in the business combination acquired relating to costs including stamp duties were expanded to period at which such cost is incurred and not included in the part of considering as well. Transaction costs are capitalized as a component of the cost of assets acquired. The default tax accounting. The default tax are recognized as a temporary difference in assets and acquired other goodwill. The liability is assumed to be business combination. India is prohibits a recognition of default tax of the temporary difference that is arising upon the initial recognition of assets and liability, and transaction is not a business combination at the time of transaction affecting the non-taxable income. India is 12 paragraph 15. According no different taxes are recognized for the temporary difference of assets and acquired on initial recognition. Situation where the fair value of asset acquired and liability assumed exceeds the fair value of consideration transfer referred to the gains and bargain purchase. If the fair value of assets acquired and the liability assumed exceed the fair value of consideration transfer plus amount of non-controlling interest, the fair value of acquired previously held equity interest in the acquisition gain is recognized by the acquiring on the compromise income and accumulative same equity and capital reserve. The asset acquired the liability assumed the measure using the allocation of fair value of consideration transfer based on the relative of the firm. As a result, no gain is recognized for the bargain purchase. Contingent liability assumed to be recognized as present obligation to arise a past event that is a fair value can be present measured of reliability and subsequent changes in the public reserve. Not reliability is the one. Illustration asset acquisition. The entity acquire an equipment and plant in exchange of 1,000 crores in cash and land. The fair value of the land is 400 crores and the carrying value is 100 crores. The fair value of the equipment and the patent estimate 500 crores and 1,000 crores respectively. Patent and equipment. The equipment patent related to the product that has been recently been commercialized in this market of the product still developing. Assuming the entity incur no transaction cost for the case of convenience tax consequences on the gain have been included. State how should be the transaction accounted. As per the paragraph 2 clause B of India is 103, standard shall not apply the acquisition of the asset or group of assets that does not constitute business. In this case, the acquirer shall identify the recognized individual identifiable asset acquired, including the assets that meet definition of a recognized criteria. Intangible asset, that is India is 38 intangible assets and liability assumed. The cost of the group of shall be allocated at the individual identifiable assets and liability on the basis of this relative fair value on the date of purchase, and this transaction or event does not give rise to goodwill. In the given case, the acquisition of the equipment and patent does not require acquisition of a build business or as equipment, the patent related to products that will recently be commercialized. The cost of asset are acquired in determined based on the fair value of asset given unless the fair value of asset is received and used reliable determination. In this given case, fair value measured the land appear more reliable than the fair value estimate of the land equipment. As the entities record the acquisition of the equipment plant as 1,004 crores. Total fair value 1,004 crores allocated the individual asset acquired in the base of the relative estimate of fair value. Entities would record the gain as 300 crores in difference between the fair value and value. Equipment record the fair value 50 crore, 100 crores by 1,479 crores, and the patents record the relative values 1,000 by 1,993 crores. Scope under the NDA is 3. My Indian account is under the applies transaction and other event that meets the definition of Indian business combination. Indian account standard does not apply the formation of joint agreement, acquisition of assets, and group of assets. It does not constitute a business. It is an asset acquisition. Definition of business combination. India is one or three business combination occurs when the entity obtains control of the business and acquiring net assets and acquiring a significant entity interest. Entity can obtain control of business by conducting only in which case of acquirer would neither have acquired net assets or not accurate equity interest. In this case, preparing balance sheet controlling interest would be zero or non-controlling interest of 100%. In these two elements are required by transaction to be business combination under the NDAs 103. Acquirer shall obtain the control of acquirer controlling the NDAs 110 and acquirer of the business. Acquirer might obtain control over the acquirer in the various ways. For example, transaction cash and cash equivalent other assets, including net asset and acquirer by incurring liability by incurring equity interest by providing more than one type of consideration. A method transferring consideration including only contract only. The business combination may be constructed by variety of way of legal, taxation, other action, which include by way of not limited to one or more business became subsidiaries of the acquirer or the net asset of the one or more business are legally merged into acquirer. One combination of equity transfer into a net asset, the owner transfer the equity interest in another combination asset and owners. All the combination entities transfer their net asset as the owner of this entity transfer the equity interest to the newly formed entity. Sometimes it referred as a roll up to the transaction group of former owners. One of the combined entities obtain control of the combined entity. Definition and element of business. Definition of business as per the para B7 of application guidance and NDAs 103. Business consists of input and purchase and processes apply to the input that has been ability to contribute to creation of output. Although the business usually have outputs are not required of the integration set of activities and assets to qualify for business analysis. NDAs 103 defines a business as an integrated set of activities and activity asset, but capable of being conducted and managed for the purpose of providing goods and services to consumers, generally invest in income such as dividend and generating other income from ordinary activities. Transaction to meet the definition of business combination and acquisition method of transaction means the definition of business combination and acquisition method of accounting and applying. Entity must contain control of integrated set of assets and activities that more than collection of assets and combination of assets and liability. It is straightforward in most cases and determine whether the business has been acquired. Yeah, business would normally be carried out in continuous trade. For transaction method and the definition of business combination and acquisition method of accounting and apply. The entity must gain control of the integrated set of assets and activities that is more than the collection of assets and combination of assets and liability. It will straightforward more cases and determine whether the business has been acquired. The business would normally be carried out on a continuous trade of identifying revenue and means that assets and combination of assets and liability to acquire entity interact with each other. Importantly, with the people who operate assets and business and however determine whether the business has been acquired may not be easily and some cases it judgment. Elements of business. The three elements of business definition the following: input, economic resource of carrying out output, the ability to contribute to the creation of output, one or more process and apply to it. Non-current asset including intangible assets or right to use non-current assets, intangible property, and ability to obtain access to the necessary material and right to process any system standard protocol convention rules that are applied in the input output creating output, the ability to contribute the creation of outputs like strategic management process and operation process and resource management process. These processes typically are document but the illustrate intellectual capacity of the organized framework having necessary skills and expertise following the rules and convention may provide necessary process that is capable of being applied to the input to create an output. Accounting, billing, payroll, and other administrative system typically are not processed and are used to create output. The output result of input process applied to input and provide goods and services and customer generate investment and input investment income and the dividend and interest and generate other income from the ordinary course and further assistant the capable of being conducted in the management of purpose of identifying the definition of business integrate set of activities and asset acquired to essential elements input and process apply to the input. There is an integrated set of activities that act asset which include the minimum output input and substantial processes together simplify the contribute the ability to create output substantial processes that determine whether the acquire process substantial following consider in a set of activities as such does not have the output for acquiring it output it is a crucial to ability to develop and convert and acquire input into output and input acquired both organized workforce that is necessarily skills knowledge and experience to form the processing group and the input that is organized workforce and it develop convert into output. Other inputs would include the intellectual property that could be used in developing goods and services. This is the economic resources that is used to develop, create inputs, and the rights to obtain access to necessary principal materials and the right to enable creation of future operates. If we set out the activities and assets, the assets have the output and acquisition rights. The acquisition process shall be considered subsequently if when applied to acquire input output. It's crucial to ability to continue processing output and the input acquired including the organization workforce necessary skill knowledge experiment to perform the process and group of processes significant contributes ability to continue producing output and is considered unique as cannot be replaced without significant cost effort delay in ability to continue producing output concentration test in the paragraph 6b of guidance of NDA's 103 optional test. This has been brought up introduced in parameter simplified assessment whether the acquired set activity of assets and not on business. The basics of this about test is made. Not a business test is met and not further assessment is needed. Test is not made. Further assessment is made. Following conditions should be presented to meet the concentration test. Concentration test as per the paragraph 80b7a of the applicable guidance of NDS 103. Concentration test is met if substantially all the fair value of the gross asset acquired is concentrated in a single identifiable asset and group of similar identifiable asset for the concentration test. The gross asset acquired the same execute cash and cash equivalent default tax asset and it will result from the effect of the default tax liability. The fair value of gross asset acquired shall include concentration transferred fair value of non-controlled asset the fair value of the previous held and excess of fair value net identifiable asset acquired. A single identifiable asset shall be include the assets and group of assets that would be recognized and measure the single identifiable assets and business combination. If an intangible asset is attached to it and cannot be physically removed and used separate from another intangible asset as underlying asset subject to a lease and defined in the India 16 without incurring significant cost and significant diminution of utilizing fair value of the other asset, for example, land and building. These assets shall be considered as a single identifier asset. When assessing whether the asset is similar entity shall consider the nature of each single identifier asset as a risk associated with the managing creating outputs from the asset. For example, risk concentration. The following shall not be considered as a similar asset. Tangible assets and intangible assets. Tangible assets are different classes unless there is considered specific identifiable asset acquired in the criterion of subparagraph identifiable intangible assets and following classes. The financial asset and non-financial asset. Financial assets are different classes. Identifiable asset that we are same class of asset but having significant different criteria categories. Concentration test is an optional test and the decision to apply made transaction on basic basis does not prohibit any entity to perform detailed test of assessment using identity assessment of applicable given in the standard. Three-step reducing concentration and measuring the fair value of goods asset required and identify a single identified assets or group of similar identifiable assets. Determine substantially all the value determined point A concentration being determined point B and asset acquire otherwise need to access the business definition and honestly. Fair value of gross asset has been determined as 1 plus 2 minus 3. Fair value of concentration transferred include fair value of non-controlling interest and fair value of previous interest plus fair value of liability assumed minus cash equivalent and default tax goodwill resulted from DLT. On concentration test entity A 20% interest on B subsequently A further acquires 50% interest on entity B and paying 300 crores. Fair value of asset on the building 1000 crores, cash investment 200 crores, and financial liability 800 crores and DAL, DTL 40 crores. Fair value of entity B 400 crores and fair value of DCI 100 crores. Over 30 was is what that was, and the final previous held interest is 20 crores, 20% and 50 crores. He said he needed to determine whether the acquisition has been asset acquired in the concentrations. The fair value consideration in the non-controlling interest and 300 plus 120 plus 80, 80 plus 300 plus 120 plus 80. Mm, fair value liability assumed in the DX and default 800 crores. And cash and cash equivalent to 100 crores. So the fair value of cross asset equivalent is 1100 crores. Or in the above scenarios, essentially all the fair value cross asset acquired in the concentration in a single identifier asset is building since it should be asset concentration 91% of the gross value is concentrated single asset vessel building, and the judgment is required to conclude that the whole substantially same is not defined standard that this view of 91% of substantially conclude in the above transaction of acquirer.